Well, happy Friday. We delayed our normal Thursday call to today in order to capture the data from the BLS report, the Bureau of Labor Statistics report that came out today. Of course, this is a big read on job production over the last 30 days. Strong reports have not been friendly to interest rates, and this one was very strong, y'all. So we're going to dive into it and talk more about it. Let's look right at the numbers. Not nearly as bad as I would have thought given the strength of this report, or at least the strength of the headline number of this report. Mortgage News Daily has the national average for a 30-year fixed rate loan this morning at 7.01%. Yesterday we were at 6.99%, y'all, so we're almost unchanged. I mean, two-tenths of a point. It's just not much movement in a one-day period, and especially owing to how strong this report was. A week ago we were at 6.91, so we did see rates move not quite an eighth of a point over the last 7 to 10 days, as the bond markets have braced for what this jobs number might give us. And then we get this headline number that was much stronger than expected, and let's look at that. As a reminder, though, 30 days ago, we were at 7.03%, so we're back to where we were to start the month, but we did see rates trending lower mid-month and then start trending higher again going into this report today. Here's what the report gave us. 303,000 new jobs created. Markets were expecting 200,000. We also saw revisions to the prior 2 months. That's the first time we've seen prior month revisions upward in this report. We had talked some about, frankly, some shenanigans that we were suspecting in these numbers, because we'd see these massively high misses to the upside, and then we would see prior month revisions knocking them back down again to reality. We didn't see this time. We've seen upward revisions to both December and January jobs numbers. So there is genuine strength in the labor markets. However, there is a reason that bonds are not reacting more negatively towards this. There's a reason rates are pretty much unchanged day over day. And that is because the internals of this report that show much of the job growth is either in part-time jobs, additional second jobs, jobs in the sub-19-year-old range, and jobs in the 55 and over range. That's where the majority of the job creation rests in this report. If you look at folks that are between 20 and 54 years of age, in other words, these are the high wage earners in our economy, that segment actually lost jobs in the household survey. For that reason, that mixed bag reason, that's why you saw some reaction to the headline number, but not an overt one, not much movement that you would have expected with that miss. When I first heard that number, y'all, I was bracing for what interest rates were going to do today. And then when the details of the report come out and you start seeing some of these weaker internals, the response from the bond market, while negative, was not nearly as sharply negative as I expected. So in any event, rates are a little bit higher, y'all, and they have been trending higher over the last several weeks. That trend line, I'm hoping we can interrupt with some friendly inflationary news going forward. So as that happens, I will be right back in front of this camera giving y'all the news. So looking forward to being able to do that. It will happen at some point, y'all. Guaranteed, we will see inflation start to moderate at some point in a way that the Fed is going to indicate to the bond market that it's time for pricing to improve. When that happens, we're going to be all over it. Hope everyone stays blessed. Stay safe this weekend. There's likely to be some craziness going into Monday. Stay safe as you observe the eclipse. Keep your glasses on, y'all. Don't stare at the sun. It's not good for you. Talk to you next week. And I don't know how to end this call. We'll just end it. Be blessed. Stay safe.